Welcome back to the Apartment Dealer Show. Over the last couple of weeks here, we've been discussing the three foundational pillars when an investor like yourself is building your financial legacy in multifamily investments. Now, for a quick roundup, pillar one was maximization. This is where an investor asks themselves, am I fully maximizing, capitalizing on the property or properties that I own? Have I done what needs to be done in terms of increasing the net income, improving the property from within, thus increasing the property's value or equity, so that I can then pivot to pillar two, which is growth. Now, as an investor, you're probably one of three types. You're either probably currently retired and your properties provide for your standard of living. You're currently working or running a business. So the properties that you own now, the goal is that they will provide for your standard of living sometime down the road. Or you're the third type where you own what you want to own, and it's more so you're thinking about the heirs. What should I do now for the heirs? So any growth for yourself means a change in the standard of living for the next generation behind you. In either case, any growth that we can see in terms of net income, number of units owned, and maximizing our tax savings increases our standard of living either today, tomorrow, for the next generation down the road. So now let's transition to pillar three. Pillar three is preparing for tomorrow. Now, for those of you who may be in the early years of your investment life, I don't want you to now shut the video off and think this has nothing to do for you, because retirement or exiting real estate is, many years down the road. We want to have an understanding of whatever it is that we're doing today impacts our future self, if you will. So we want to make those decisions today that our future self will thank us for. And if we know what investors who are 20, 30 years down the road from where we are today, what they're pondering, what they're thinking about, the things that they have to tackle, if we know that today, it helps us better strategize and maneuver our portfolio in the coming years. So stick with me. So we are talking about pillar three, preparing for tomorrow, which typically encompasses questioning, how do we exit? We've built our portfolio over time. We have the cloud of capital gains hanging over us. How do you exit? And in exiting, how do we do one of three things? How do we alleviate the capital gains burden, the capital gains taxes? Two, if we sell our properties, so now what do we do about monthly cash flow? So where does our monthly income come from? And then third, of course, is we're thinking about exiting because we want to alleviate ourselves of the property management, of the headaches, and of the expenses. Now, to do this, there's a couple avenues. The first avenue many turn to is they actually sell and do a 1031 exchange. So that checks box one, that gets rid of capital gains tax because you're doing a 1031 exchange. But they move into an asset class that has no oversight from them. It's usually one of two types. The first one being a triple net lease. Quickly, what a triple net lease is, if you're familiar with Walgreens or CVS, Dollar Tree, Jack in the Box, all these tenants are just that, tenants. They typically do not own the real estate that they consume. And it's an investor like yourself who actually owns the location. And in those type of leases, the tenant is responsible not only for the monthly lease, but they're also responsible for the repairs of the property. Oftentimes, they're also responsible for paying the property taxes and all the utilities. So it's called a triple net lease. And so there's no oversight from you and no expenses. But which can seem like a blessing also can be a curse, because now you have no expenses to put against your income. So your income has that much more exposure to annual taxes. Second, these locations oftentimes are built to suit, meaning they're built to suit one type of tenant. And oftentimes investors go out of state chasing attractive returns. So now you've purchased an asset out of state that has maybe only one type of tenant in mind. Well, what about in the case of a vacancy? What if, like we see today, where companies are going bankrupt? What if the tenant vacates or goes bankrupt? What now? So while some do look to that type of investment, for many, it's not that appealing. Then there's DSTs. What a DST essentially is it's a company who pulls together several investors like you, and you're able to go out and buy an asset that one wouldn't be able to buy on their own because of the capital that's needed. So you can buy, say a large medical complex or a large student housing type complex. In this case, again, you've done a 1031 exchange, so there is no capital gains to pay. You do have tax write-offs because you physically own the property, but you only own a minority share. So the issue here is you lose control. You're one vote among many. What happens with the property, what type of debt is put on the property, when the refinance happens, the annual management. And so for many investors, again, this ends up not being appealing because they lose that control component. Then you could sell and cash out and put your money in the bank. The only issue there is, yes, you've gotten away from any management headaches and the expenses associated with management, but you have the capital gains tax. And the monthly income, based upon interest rates today, maybe you're getting paid 1% to 2% return on your money. So the return there isn't that attractive. Again, the biggest hurdle here is what to do about the capital gains tax. So many of you will opt to hold your properties so that then you can will them on so that your heirs can inherit the properties. Because in many cases, given the tax structure of today, if your children or the next heirs in your trust were to inherit the properties, there would be no capital gains tax to pay. The question there is, have you had the discussion with your children? What are their wishes? Oftentimes in meeting with our clients, the children actually wish that the parents would sell so that one, the parents can enjoy the money now, right? Enjoy the fruits of their labor. Second, so that the parents can be at peace. Oftentimes these landlords feel like they're so tied to the properties or they have to be available at the beck and call of the tenants that they won't go on vacations for any length of time. And, that begins to have an effect on their lifestyle in their later years. So the children say, look, just sell. We realize there's capital gains to pay. And yes, that would be that much more money we would inherit, but we would prefer that you be at peace. It's not a big deal. So that's one question to have with the heirs. The second question is, if there's multiple heirs involved, let's say your children, do they all have the same goals financially? The problem that we see many times is that the siblings are in different places financially. They independently have their own goals. They would prefer to hold the properties. Some would prefer to sell the properties and have their equity at once. And it's not clearly defined. The instructions are not there from you, the owner. Are they supposed to sell immediately upon inheriting them? Or, like many of my clients say, they say, Chris, look, I would sell, but the capital gains tax is the issue. So I'm just going to hold and then my family can figure it out when I'm gone. The problem with the family figuring it out, and your family, so I'm not suggesting that everyone has an issue, but in some cases, and again, I come in when the attorneys call me and say, you've been selected to represent the family now because they've petitioned the court for a sale because the kids are at odds. That's the issue, is that if the family hasn't had a family meeting and said, look, if and when you inherit the properties, is everyone in agreement to hold? Would everyone prefer to sell? Or maybe we need to restructure our assets so that if it's possible, everyone can inherit their own property so that they can choose for themselves. So how you would say, but Chris, I only own one property, or I own two properties, but I have 4 children, or there's no way to dissect the properties evenly where all the kids would feel like they're getting an even cut of the estate. I'm going to refer you, and we'll link to the video here, of a video that I did with Greg Burns of IPX. In that scenario he laid out, his client was dealing with just that. He had, I believe it was 2 or 3 sons. And he said, look, the owner, the dad, I'm going to sell my property, and then we're going to go do an exchange. Each of you boys are going to pick the property that you want within the confines of our exchange, how much capital available and what we have to replace as our cost and so forth. And then you're going to manage those, we're going to create an LLC, and we're going to manage those properties, or you're going to manage those properties. I'm going to pay you a management fee. And then when I pass, you've picked your own property. See, in that scenario, you come out shining like a star because your heirs chose the properties. Everybody got an even cut. Nobody feels like, hey, they were dad's favorite, mom's favorite, something like this. So that's one thing to consider. But going back to, okay, what is another avenue? So let's say at this point you say, Chris, I'm not interested in a triple net lease. I've looked at those. I'm not interested in a DST. I don't like the fact that I won't have control. I don't want to sell and pay Uncle Sam 30, 40, 50% of my equity and then put my money in the bank only to make 1% return. And my kids aren't necessarily worried about our estate. Maybe you have no heirs behind you. So you need an exit strategy. What are you to do? Well, you can sell and carry back the financing. Now, the way this works is that you physically sell your properties to a new buyer. And typically they're going to put 25, 30, 35% down in cash. The remainder you provide in the form of a private note to them. It's a note on paper. There's no exchange of money from you to them because it's on paper. And the property serves as the collateral. Well, what does this accomplish? Number one, you've sold the property. So there's no management headaches, no more expenses. Number two, monthly income. You will have a monthly income for as long as the duration of that note. We've had some clients structure it so that it's a 3-year note, a 5-year note, 10-year note. You could do 15, 20, 30. It's up to you as the seller how long you would want to carry the financing, how much you would want in the form of a down payment. And then in terms of the interest rate, that's negotiable as well. Typically, it's tied to whatever the prevailing rate is in the market. You'll charge maybe 1% to 2% above that, but it depends. Every case is different. So you've relieved yourself of the management. You have monthly cash flow. And in terms of the taxes, for the duration of time that you carry the note, there is no capital gains to pay on the loan balance. And then the taxes are paid when the balloon payment comes due. We're going to take you now to some footage from our recent educational luncheon where we actually walk through how does this math work for a real life client story. But first we begin with Chuck and Ann. This was a situation where husband and wife, up in their later years, husband's concern is if I pass, everything falls on the shoulders of my wife. I'm not necessarily concerned with her inheriting the properties. I want her to have the cash flow to provide for her. So can we structure something where she would have cash flow, no management? That's where we pick it up now. Let's go to that footage. Chuck has a medical condition, begins to think, hey, if I go down and all the units fall in my wife's lap, I don't necessarily want her to deal with tenants. I want her to have the income. That's been the whole idea, these properties for retirement, but I don't want her to deal with all the tenant and repairs because Chuck did that. That was his lane. Just like for me and my wife. If I go down, everything falls on my wife's lap, right? This idea where as right now, primarily I deal with the rentals. So we analyzed it. We said, okay, well, what can we do? Well, if you sell and carry back financing for the buyer, so simple math, let's say you have a property that's worth $1 million. The buyer puts down 30% in cash to you at the close of escrow, so you get $300,000 up front. And the remaining $700,000 you carry back in the form of a note. And you could carry that for 3 years, 5 years, 10 years. It's really dependent upon your goals in terms of how long you want that income. The interest rate today probably would be somewhere between 4 to 7%, depending. And so you've relieved yourself of the management, you have monthly income from the note, and you've mitigated the taxes for the amount of time that you carry the note. So how does some of this work financially? I just sold this 5-unit with my partner, Deepan Shah, who brought me up a little earlier. 5 units Ontario, sales price, $1,150,000. This is the one I told you that was the highest price per unit. How did that happen? Well, by offering private financing, instead of just getting 2 offers, I think we got like something close to 8 offers. There's actually a gentleman here sitting in the second row, I won't point you out, that once the bid started getting this crazy, he said, okay, Chris, that's it, I'm out. Actually, 2 gentlemen are in this room who bid on this, and they got so high, they're smart enough, they said, I'm out. The guy who ended up buying it ended up paying $250,000 more than the list price. Now, this is where I do the disclaimer, it goes across the bottom, your results may vary. I'm not saying just because you carry back financing, you're gonna have this huge upswing in price, but you're gonna have more offers, especially in a rent control market where financing is getting tighter. Since you're developing the loan yourself as the seller, you're gonna receive more offers, and with that, we assume a bid process which will increase the price. Now this family, had they just sold and cashed out, they would have netted $1,075,000 from the sale and then would have paid their taxes from there. But what if they carry the financing? We had the buyer put 25% down, $287,500 down initially. The loan amount, $862,000. We carry it at 4.6% annually, so the annual income to them was $39,675, which nearly replicated what they were earning from the property when they were managing it themselves. So when we compare side by side, you could cash out $1,075,000, pay the taxes, or carry the note, in this case for 5 years, and between the initial down payment, the interest payments, and the loan payoff, you net $1,348,375 over the course of the loan. And in addition, you sell it above market pricing. Now, so that you can hear from them why they sold, it's the Inman family, we'll let them share their story.
Little by little, they got renters that came in, and most of their renters ended up being like family orientated. They made it like a family orientated apartment where the people lived there for years. What brought us to the decision to finally sell and move on was we felt we were getting older now, and we do not want the responsibility of having to look after them anymore. And then we also had a gentleman by the name of Chris German come around and call on me for about 1.5 years and asking me, finally he called one day and I was kind of caught off guard. And I said, well, I'll tell you what, if you can come and convince my husband to talk to you, because you are in the real estate business, and he doesn't have too much to say about the last real estate decision that we made. So if you can come and talk to him and get him to talk to you about it, then it'll be fine. One of the advantages was that we were getting interest on it for 5 years, and made the price of the property go up higher than what we sold it for.
Because of the opportunity to the buyer. It was easier for the buyer to take over and set up the financing was all us. We were like the bank, and we liked the interest rate per month, and there was other options we were offered on that, but we chose one that we wanted to do. But if somebody was thinking about selling and don't need the finances, sent to you all at one time, and you can make X amount of dollars per month, more than you're actually making if it was sitting in the bank, it'd be a smart way to go. Because you look at this and the net is almost the same as we had if we owned them, and we have no headaches. I still, and that's the good way to look at it. And I'd recommend this to anybody that wanted to contact us or anything, that they were handled very professionally. And that's what I made my decision with.
I hope that footage helped explain exactly how a seller carry functions. Now, if you're curious, what would that mean to your own situation? Please feel free to reach out to me, or reach out to our offices, send me an email. And if you're within our service area, we'd be more than happy to outline the structure of what a potential sale would look like with you providing private seller financing. Even if you're outside our area, drop me an email. I'm happy to share or answer any questions you may have in terms of how does this function.